Welcome to Subconscious Wealth. You don't need to be wealthy to start, you need to start to become wealthy. You don't need to be a genius, you need to be disciplined. You don't need perfect timing, you need time and patience. As your eyes grow heavy and your breathing slows, let these 20 principles settle into your consciousness. Investing isn't mysterious or only for the wealthy elite. You too can become wealthy through the listening and implementation of this information in a calming and anxiety-free way. No yelling or judging you here. Come learn with me. Close your eyes and imagine this. Cheryl, age 28, sits in her small apartment as golden evening light filters through the window. She's just received her first real paycheck from her new job, and for the first time in her life, she has money left over after paying bills. The question that keeps her awake at night: what do I do with it? According to the Securities and Exchange Commission, over 60% of American households invest in the stock market, building wealth slowly and steadily over decades. But Cheryl, like millions of young Americans, never learned how. Tonight, as you drift toward rest, you'll journey with Cheryl through 20 fundamental investment principles. These aren't get-rich-quick schemes or risky gambles. They're timeless strategies taught by the SEC, FINRA, and financial regulators whose job is to protect investors like you. Let's breathe deeply and begin your investment education. Tip number 1. The foundation you cannot skip: build your emergency fund first. Cheryl's friend suggests she immediately invest her extra money in stocks. But Cheryl remembers reading something on investor.gov, the SEC's official site for individual investors. According to FINRA, the financial industry regulatory authority that protects investors, before you invest a single dollar, you must establish an emergency fund. Financial experts recommend saving 3 to 6 months' worth of essential expenses in an accessible account. Why? Because investments can lose value. If Cheryl invests all her money and then faces a car repair or medical bill, she'd be forced to sell investments at the worst possible time, maybe at a loss. The emergency fund acts as a financial cushion, protecting both her daily life and her investments. Cheryl calculates her essential monthly expenses: rent, utilities, food, transportation, insurance, about $2,400 per month. Her goal: save $7,200 to $14,400 before investing. Investment basic number 1. Establish an emergency fund of 3 to 6 months' expenses in a liquid, accessible savings account before investing. This protects you from being forced to sell investments during emergencies, and it's the foundation recommended by federal financial regulators. Keep this money safe in high-yield savings accounts or money market accounts, not in stocks or bonds. For the first 6 months, Cheryl focuses entirely on building this safety net. Tip number 2. The debt that steals your future: eliminate high-interest debt. Cheryl carries $3,000 in credit card debt at 22% annual interest. Her friend suggests investing instead of paying it down, hoping to earn returns in the stock market. The SEC's Office of Investor Education is clear on this point. Paying off high-interest debt is often your best investment. Credit card interest of 18 to 25% is nearly impossible to beat with investment returns, and it's guaranteed savings. If Cheryl carries that $3,000 balance and only makes minimum payments, she'll pay thousands in interest over time. But if she aggressively pays it down, she saves that money with certainty, something no investment can guarantee. Investment basic number 2. Before investing, pay off high-interest debt like credit cards. The interest you're paying, often 18 to 25%, is higher than average investment returns. Think of debt payoff as a guaranteed return on your money. Once you've eliminated high-interest debt and built your emergency fund, you're ready to invest from a position of strength. Cheryl makes a plan. Emergency fund first, high-interest debt second, investing third. Tip number 3. The eighth wonder, start early and let compound interest work. 8 months later, Cheryl has her emergency fund and no credit card debt. She's ready to invest. But she worries, is 28 too late to start? The SEC provides a compound interest calculator on investor.gov to show investors the power of starting early. The concept, attributed by some to Albert Einstein as the eighth wonder of the world, is simple. You earn returns not just on your original investment but on your returns as well. FINRA explains it this way: compound interest is interest earned on interest. If you invest $5,000 today at an average 7% annual return and never add another dollar, in 30 years you'll have over $38,000. But if you wait just 10 years to start, that same $5,000 becomes only $19,000. You lose nearly half the growth. The math is undeniable. Time is an investor's greatest advantage. Every year you wait costs you not just the money you might have invested, but the compounding growth on that money. Cheryl opens her first investment account that night. Investment basic number 3. Start investing as early as possible to benefit from compound interest, earning returns on your returns. According to the SEC, even small amounts invested early can grow substantially over decades. A 25-year-old investing $200 monthly at 7% annual returns will have more at age 65 than a 35-year-old investing $300 monthly. Time matters more than amount. The best time to start was yesterday. The second best time is today. Tip number 4. Time in, not timing. Stay invested for the long term. Cheryl watches financial news showing market ups and downs. She wonders if she should wait for the right time to invest, or pull her money out when markets fall. FINRA's investor education emphasizes a critical distinction. Time in the market beats timing the market. Research shows that investors who try to time the market, buying when they think it's low and selling when they think it's high, typically underperforms those who simply stay invested. Why? Because the market's best days often follow its worst days, and if you're out of the market trying to time your entry, you miss the recovery. According to financial studies, missing just the 10 best market days over a 20-year period can cut your returns nearly in half. Investment basic number 4. Focus on time in the market, not timing the market. Stay invested for the long term and ride out volatility. The SEC notes that historically, despite wars, recessions, and crashes, the stock market has trended upward over long periods. Short-term volatility is normal. Long-term growth is historical. Emotional decisions to sell during downturns or buy during peaks typically hurt returns. Cheryl commits to a long-term investment strategy. Tip number 5. Never all your eggs. The power of diversification. Cheryl's coworker suggests she invest everything in a single hot technology stock that's guaranteed to skyrocket. It sounds tempting. But the SEC's beginner investing guide tells a different story, using a simple metaphor. Don't put all your eggs in one basket. This principle is called diversification. Spreading investments across different assets so that if one fails, your entire portfolio doesn't collapse. FINRA explains that diversification reduces risk without necessarily reducing returns. By owning many different investments, different companies, different industries, different asset types, you protect yourself from any single investment's failure. If Cheryl invests everything in one stock and that company fails, she loses everything. But if she owns 100 different stocks through a mutual fund and one fails, she barely notices. Investment basic number 5. Diversify your investments across multiple assets, industries, and asset classes. Don't concentrate wealth in a single stock or sector. According to the SEC, diversification may reduce portfolio volatility and risk. Spread investments among stocks, bonds, and other assets, and within stocks, own many companies across different industries and regions. Diversification doesn't guarantee profits or protect against all losses, but it's fundamental risk management. This is simpler than you think. Tip number 6. The right mix understanding asset. This is simpler than you think. Diversification leads to another question. How much should Cheryl invest in stocks versus bonds versus cash? This decision, how you divide your money among different asset classes, is called asset allocation, and according to the SEC, it's one of the most important investment decisions you'll make. Different assets behave differently. Stocks offer higher potential returns but more volatility. Bonds provide steadier income but lower growth. Cash offers safety but minimal returns that may not keep pace with inflation. FINRA guidance suggests that younger investors like Cheryl can typically accept more stocks in their allocation because they have decades to recover from market downturns. Older investors nearing retirement often shift toward bonds and cash for stability. A common rule of thumb: subtract your age from 110 to determine your stock percentage. At 28, Cheryl might allocate 82% to stocks, 18% to bonds. Investment basic number 6. Determine an appropriate asset allocation based on your age, risk tolerance, and time horizon. The SEC notes that asset allocation, deciding what percentage goes to stocks, bonds, and cash, significantly impacts returns and risk. Younger investors can typically handle more stock exposure. Those nearing retirement often prefer bond stability. Rebalance periodically to maintain your target allocation as markets move. Tip number 7. Removing emotion, the strategy of dollar cost averaging. Cheryl worries about investing all her money at once. What if the market crashes tomorrow? FINRA describes a strategy called dollar cost averaging, investing a fixed amount at regular intervals regardless of market conditions. Instead of investing $6,000 all at once, Cheryl could invest $500 monthly for a year. This approach offers 2 benefits. First, it removes the emotional pressure of trying to time the market. You invest consistently whether markets are up or down. Second, when prices are lower, your fixed amount automatically buys more shares. When prices are higher, it buys fewer. The SEC notes that dollar cost averaging won't guarantee profits or protect against losses in declining markets, but it does provide a disciplined approach that reduces the risk of investing all your money right before a market decline. Investment basic number 7. Consider dollar cost averaging, investing fixed amounts at regular intervals, to reduce timing risk and remove emotion from investing. This strategy, recognized by FINRA, helps you avoid the mistake of investing everything right before a downturn. Many workplace retirement plans automatically use this method through regular paycheck contributions. It's a psychologically easier way to build an investment portfolio systematically. Tip number 8. Know what you own, understanding your investments. Cheryl's friend invests in something called a cryptocurrency staking derivative that promises 50% annual returns. When Cheryl asks how it works, her friend can't explain it. The SEC's investor education materials emphasize a simple rule: never invest in anything you don't understand. According to federal regulators, understanding your investments means knowing how they work, what risks they carry, and what fees you'll pay. FINRA requires investment products to provide disclosure documents explaining these details. For mutual funds, it's the prospectus. For bonds, it's the offering statement. These aren't optional reading, they're essential. If someone offers you an investment opportunity and can't clearly explain how it works, or if the explanation involves complex jargon designed to confuse rather than clarify, that's a red flag. Investment basic number 8. Only invest in what you understand. The SEC urges investors to read disclosure documents, understand how investments work, what you're paying in fees, and what risks you're taking. If you can't explain an investment in simple terms, don't put your money in it. Complexity isn't sophistication, it's often a warning sign. Traditional investments like stocks, bonds, and index funds are straightforward and time-tested. Tip number 9. Fees that devour returns keep investment costs low. Cheryl compares two mutual funds. Both invest in similar stocks, but Fund A charges 0.05% annually in fees while Fund B charges 1.5%. Her friend says, "What's 1.5%? That's nothing." But the SEC's compound interest calculator tells a different story. Over 30 years, that extra 1.45% in fees can cost Cheryl tens of thousands of dollars. Money that goes to fund managers instead of her retirement. FINRA provides a fund analyzer tool that shows how fees impact returns over time. Even small differences in expense ratios compound dramatically over decades. A $100,000 investment at 7% annual returns with 0.05% fees grows to $738,000 in 30 years. The same investment with 1.5% fees grows to only $545,000, a $193,000 difference. The SEC emphasizes that you cannot control market returns, but you can control fees. Investment basic number 9. Minimize investment fees and expenses. According to the SEC, even small differences in fees dramatically impact long-term returns. Compare expense ratios using FINRA's Fund Analyzer tool. Low-cost index funds often charge 0.03 to 0.20% annually, while actively managed funds may charge 1 to 2%. Over decades, high fees can consume hundreds of thousands of dollars. Every dollar paid in fees is a dollar not growing for your future. Tip number 10. Simple and effective. The case for index funds. Cheryl's uncle manages his own stock portfolio, spending hours researching companies. He suggests Cheryl do the same, but she works full-time and doesn't want investing to become a second job. According to financial research frequently cited by the SEC and FINRA, index funds, which simply track a market index like the S&P 500, outperform most actively managed funds over long periods, especially after accounting for fees. Index funds don't try to beat the market, they become the market. They own a little piece of hundreds or thousands of companies, providing instant diversification. They charge minimal fees because there's no expensive fund manager making stock picks. And they require no research or stock selection from you. For decades, legendary investor Warren Buffett has recommended index funds for most investors, even instructing his own estate to invest in them. Investment basic number 10. Consider low-cost index funds as a core holding. The SEC notes these funds track market indexes, provide broad diversification, charge minimal fees, and historically outperform most actively managed funds over time. You can build an entire investment portfolio with just 2 or 3 index funds. One for US stocks, one for international stocks, one for bonds. Simple, effective, and time-tested. Cheryl decides to build her portfolio around index funds. You're getting this. If this is helping you feel more confident about investing, and you'd like to see more bedtime finance education, consider subscribing. But no pressure. Rest is what matters most. Sweet dreams. Tip number 11. The building blocks: understanding stocks, bonds, and cash. Now that Cheryl has chosen her strategy, she needs to understand the basic asset types. FINRA's investor education describes 3 primary asset classes. Stocks represent ownership in companies. When you buy stock, you become a part owner and benefit from the company's growth through price appreciation and dividends. Stocks offer the highest potential returns but also the most volatility. The SEC notes that over long periods, stocks have provided average annual returns around 10%, though with significant year-to-year variation. Bonds represent loans you make to companies or governments. They pay you interest and return your principal at maturity. Bonds are generally less volatile than stocks but offer lower returns, typically 3 to 6% annually. The SEC explains that bond prices move inversely with interest rates. When rates rise, bond prices fall, and vice versa. Cash and cash equivalents include savings accounts, money market funds, and short-term treasury bills. They're very safe and liquid but offer minimal returns, often below inflation. According to the SEC, understanding these building blocks helps you construct a portfolio aligned with your goals and risk tolerance. Investment basic number 11. Understand the 3 primary asset classes. Stocks offer growth potential with higher risk. Bonds provide income with moderate risk. Cash offers safety with low returns. The SEC guidance explains that your portfolio should contain a mix appropriate to your situation. Young investors typically emphasize stocks for growth. Retirees often prefer bonds for stability. Each asset class serves a purpose in a balanced portfolio. Tip number 12. Know yourself, assessing your risk tolerance. Cheryl takes an online risk tolerance questionnaire provided by investor education sites. The questions ask, how would you react if your investment lost 20% in a month? Would you sell, hold, or buy more? FINRA explains that risk tolerance, your ability and willingness to endure investment losses, is deeply personal. It depends on your financial situation, time horizon, and emotional temperament. Someone with decades until retirement, secure employment, and an emergency fund can typically tolerate more risk than someone nearing retirement or living paycheck to paycheck. But risk tolerance is also emotional. Some people sleep well when markets fall 30%, knowing recovery will come. Others panic and sell. The SEC cautions that the biggest investment mistake is taking more risk than you can psychologically handle, leading to emotional decisions that lock in losses. Cheryl realizes she can handle moderate market volatility but wouldn't sleep well with an all-stock portfolio. Investment basic number 12. Assess your risk tolerance honestly before investing. According to the SEC, this means evaluating both your financial ability to take risk, time horizon, emergency fund, income stability, and your emotional tolerance for volatility. Many investment firms offer free risk assessment tools. Choose an asset allocation you can maintain during market downturns, because they will happen. The right amount of risk is the amount that lets you stay invested long-term. Tip number 13. Resist the siren song. Don't try to time the market. The market drops 5% in a day. Cheryl's coworker sells everything, declaring, "I'll buy back in when it's safe." But according to SEC investor guidance, this is precisely the mistake that costs investors billions annually. Market timing, trying to predict short-term market movements, is extraordinarily difficult, and even professional investors rarely succeed consistently. FINRA's research shows that missing the market's best days has a devastating impact on returns. Many of those best days occur during or immediately after the worst days, so investors who sell during downturns often miss the recovery. The SEC's guidance is clear. Stay the course during volatility. If you've chosen an appropriate asset allocation based on your risk tolerance, maintain it through ups and downs. Investment basic number 13. Resist the temptation to time the market. The SEC and FINRA consistently warn that market timing typically reduces returns rather than enhancing them. You can't reliably predict short-term movements. Instead, maintain your allocation, rebalance when needed, and trust in long-term market growth. As FINRA notes, time in the market beats timing the market. Tip number 14. The FOMO trap, avoiding emotional and herd investing. Everyone Cheryl knows is investing in a particular stock that's doubled in 3 months. The fear of missing out, FOMO, is overwhelming. She's tempted to invest everything. The SEC's Office of Investor Education warns specifically about this psychological trap. Herd behavior and FOMO lead investors to buy popular investments at their peak and sell during panics at the bottom, the exact opposite of smart investing. According to behavioral finance research frequently cited by regulators, human emotions are investors' worst enemy. We feel pain from losses more intensely than pleasure from equal gains, leading us to sell winners too early and hold losers too long. We chase recent performance, buying what's hot. FINRA's investor alerts warn that wherever crowds are rushing, danger often follows. The hottest investments are often the riskiest, and popularity doesn't equal quality. Investment basic number 14. Resist FOMO and emotional investing. The SEC warns that following the crowd or chasing recent performance leads to poor outcomes. Stick to your investment plan regardless of what others are doing. Popular investments are often overpriced, while overlooked investments may offer better value. The best investors are often contrarians who remain calm when others panic and cautious when others are euphoric. Tip number 15. Verify before you trust, check advisor credentials. A man approaches Cheryl at a coffee shop, introducing himself as a financial advisor who can guarantee 15% returns with his special system. He's professional, confident, and persuasive. The SEC's investor protection guidance is emphatic. Before working with any financial professional, verify their credentials and check their background. FINRA provides a free tool called Broker Check that allows you to research investment professionals, view their qualifications, and see if they have any regulatory violations or customer complaints. According to the SEC, red flags include guarantees of high returns with little risk, pressure to invest immediately, reluctance to provide information in writing, unregistered investment professionals. Cheryl goes home and checks the man's credentials on Broker Check. He's not registered. She blocks his number. Investment basic number 15. Always verify investment professionals using FINRA's Broker Check tool at brokercheck.finra.org. The SEC requires brokers and investment advisors to be registered and licensed. Check for qualifications, employment history, and any disciplinary actions. If someone claims to be a financial professional but isn't registered, they're either unqualified or fraudulent. Legitimate professionals welcome credential checks. Scammers avoid them. I'm looking out for you. Tip number 16. Vigilance, not obsession. Regular portfolio reviews. Cheryl initially checks her investment account multiple times daily, watching every small fluctuation. It's stressful and exhausting. FINRA's investor education suggests a different approach. Review your portfolio regularly but not obsessively. Quarterly or annual reviews are typically sufficient for long-term investors. During reviews, ask yourself, has my life situation changed significantly? Has my risk tolerance changed? Has my asset allocation drifted significantly from my target? Are my investments performing as expected over the long term? Are there any high fees I should eliminate? The SEC notes that reviewing doesn't mean reacting to every market movement. It means periodically ensuring your investments remain aligned with your long-term goals. Cheryl sets a calendar reminder for quarterly 15-minute portfolio reviews instead of daily anxiety-inducing check-ins. Investment basic number 16. Review your portfolio regularly but not obsessively. Quarterly or annually is typically sufficient. According to the SEC, regular reviews help ensure your investments align with your goals, but daily monitoring can lead to emotional reactions. During reviews, focus on long-term performance, not short-term volatility. Check that fees remain low, allocations haven't drifted, and your strategy still fits your life circumstances. Tip number 17. Maintaining balance, the discipline of rebalancing. A year passes. Cheryl's stocks have grown significantly while her bonds have been flat. Her original allocation of 70% stocks and 30% bonds has drifted to 80% stocks and 20% bonds. The SEC's asset allocation guidance explains rebalancing, periodically adjusting your portfolio back to your target allocation. If stocks have grown beyond your target percentage, you sell some and buy more bonds to restore the original balance. FINRA notes that rebalancing forces you to sell high and buy low, selling assets that have appreciated and buying those that have underperformed. It also maintains your chosen risk level, preventing your portfolio from becoming too aggressive or too conservative without your intention. Many experts recommend rebalancing annually or when any asset class drifts more than 5 percentage points from its target. Investment basic number 17. Rebalance your portfolio periodically to maintain your target asset allocation. The SEC explains that market movements cause your allocations to drift over time. Winners grow as a percentage while losers shrink. Rebalancing at least annually helps maintain your desired risk level and enforces buy low, sell high discipline. Many retirement plans offer automatic rebalancing, making this easy. Tip number 18. Patience over panic, maintaining a long-term perspective. 2 years into investing, Cheryl experiences her first major market correction. Her portfolio drops 15% in 2 months. Friends are selling. Financial news is dire. But Cheryl remembers SEC investor education she studied. Successful investing requires a long-term perspective. According to historical data, the market has experienced many corrections, crashes, and bear markets, and has recovered from all of them given sufficient time. FINRA guidance notes that investors with a 10-year or longer time horizon can typically ignore short-term volatility. What matters is the portfolio's value when you need the money, not its value today. The SEC's research shows that staying invested during downturns is critical. Those who sold during the 2008 financial crisis and missed the subsequent recovery permanently damaged their long-term returns. Cheryl doesn't check her account for 3 months and continues her regular monthly investments, buying at lower prices. Investment basic number 18. Maintain a long-term perspective and don't panic during downturns. The SEC emphasizes that market volatility is normal and temporary. Long-term growth is historical. If your time horizon is 20+ years, today's market price is nearly irrelevant. Focus on decades, not days. Continue investing during downturns. You're buying at sale prices. The worst investment mistake is selling during panics and missing recoveries. Tip number 19. Protect your wealth, recognizing and avoiding investment scams. Cheryl receives an email promising she's been selected for an exclusive investment opportunity that will triple her money in 6 months with zero risk. It looks legitimate. The SEC's Office of Investor Education issues regular fraud alerts about investment scams. According to federal regulators, if an opportunity sounds too good to be true, it is. Common warning signs include promises of high returns with little or no risk, pressure to invest immediately, exclusive opportunities available only to select investors, unsolicited investment offers via email, social media, or phone, unregistered investments or sellers, complex strategies that are difficult to understand. FINRA's Investor Alert System warns about relationship scams, cryptocurrency fraud, affinity fraud targeting specific communities, and dozens of other schemes designed to separate you from your money. Cheryl reports the email to the SEC and deletes it. Investment Basic Number 19. Recognize and avoid investment scams. The SEC receives thousands of fraud complaints annually. Remember, no legitimate investment offers guaranteed high returns with no risk. Before investing, verify the investment and the seller are registered with the SEC or state regulators. Be especially skeptical of unsolicited offers, high-pressure tactics, and investments you don't understand. Report suspected fraud to the SEC at sec.gov/TCR. Tip number 20. The never-ending education, commit to continuous learning. 5 years have passed. Cheryl's investment portfolio has grown steadily. She's weathered market volatility, avoided scams, maintained her allocation, and stayed disciplined. But she hasn't stopped learning. The SEC's Investor.gov provides free educational resources, calculators, and courses. FINRA offers similar tools and alerts. The investment world evolves. New products emerge, regulations change, economic conditions shift. According to the SEC, informed investors make better decisions. Spending even an hour quarterly reading investor education materials, understanding new products, or refreshing your knowledge of fundamentals makes you a better steward of your financial future. Cheryl subscribes to the SEC's Investor Alert emails and reads Investor.gov articles during her lunch breaks. Investment Basic Number 20. Commit to ongoing investment education. The SEC and FINRA provide free resources at investor.gov and finra.org/investors. Markets evolve, and staying informed helps you make better decisions, spot scams, and understand new opportunities. You don't need to become a financial expert, but basic financial literacy pays dividends throughout life. The investment you make in education about investing may be the best investment of all. You can do this. Conclusion: your journey begins. As we return to the present moment, Cheryl reflects on her journey. She started with fear and uncertainty, worried she'd never understand investing or that she'd make costly mistakes. But by following these 20 principles, taught by the Securities and Exchange Commission, FINRA, and financial regulators whose mission is protecting investors, she built a solid foundation. The foundation, Basics 1 to 4. She established an emergency fund, eliminated high-interest debt, started investing early to harness compound interest, and committed to staying invested long-term rather than timing the market. The strategy, Basics 5 to 10. She diversified her investments, chose an appropriate asset allocation, used dollar-cost averaging to reduce emotion, understood what she owned, kept costs low through index funds, and grasped the building blocks of stocks, bonds, and cash. The psychology, Basics 11 to 15. She assessed her risk tolerance honestly, resisted market timing, avoided FOMO and emotional decisions, and verified advisor credentials before trusting anyone with her money. The discipline, Basics 16 to 20. She reviewed her portfolio regularly without obsession. rebalanced to maintain her target allocation, maintained a long-term perspective through volatility, learned to recognize scams, and committed to continuous education. Now it's your turn. These 20 investment basics aren't complicated, but they're powerful. They represent decades of research, millions of investor experiences, and the collective wisdom of federal regulators whose job is protecting people like you. According to the SEC, investing isn't about getting rich quickly. It's about building wealth slowly, protecting you from fraud, and giving your future self financial security and freedom. You don't need to be wealthy to start, you need to start to become wealthy. You don't need to be a genius, you need to be disciplined. You don't need perfect timing, you need time and patience. The reality of investing. Cheryl's portfolio won't make her a millionaire next year. But if she continues these practices, contributing regularly, staying diversified, keeping costs low, and maintaining discipline through decades, compound interest will work its magic. The SEC's compound interest calculator shows that investing just $300 monthly from age 28 to 65 at 7% annual returns creates a nest egg of over $530,000. Increase contributions over time as income grows, and that number climbs to over $1 million. The math is simple. The execution requires only discipline. Resources at your fingertips. Before sleep takes you, remember these free resources. Investor.gov, the SEC's official site for investor education. FINRA.org/investors, tools, calculators, and education from FINRA. Brokercheck.finra.org, verify any financial professional. SEC.gov/TCR, report suspected fraud. SEC Compound Interest Calculator, see how your money can grow. Sleep well, invest wisely. As your eyes grow heavy and your breathing slows, let these 20 principles settle into your consciousness. Investing isn't mysterious or only for the wealthy elite. It's for people like Cheryl, people like you. It's for servers and truckers, service technicians and engineers, parents and young professionals, anyone willing to learn, remain disciplined, and think long-term. The SEC, FINRA, and federal financial regulators have created these guidelines to protect you and help you succeed. They're not trying to make investing complicated, they're trying to make it accessible and safe. Start where you are. Use what you have. Do what you can. Build your emergency fund. Eliminate high-interest debt. Open an investment account. Choose low-cost index funds. Contribute regularly. Stay the course. And 20, 30, or 40 years from now, your future self will thank you for the discipline you showed tonight. 20 basics. A lifetime of financial security, all accessible to you. Sleep well, knowing that your financial education continues even as you rest. Tomorrow is a new day, and tomorrow you can take the first step, or the next step, or simply continue the journey you've already begun. Sweet dreams, and may your investments grow while you sleep.